Today we have David Clark, CIO at VenCap International, and we will be talking about breaking down the VC fund size bias. So, David, thank you very much for your time. And I think the first question has to do with how do you define the size of a VC fund? No? What is a small, medium, or large fund?
I think that's the wrong way to think about venture capital. We don't really look at funds and go, if that's a small fund, we'll invest in. If it's a medium-sized fund, we will, or it's a large fund, we won't. We think venture capital is all about investing in the very best companies. And if you're able to do that consistently, then to a large extent, it doesn't really matter what size fund you have. If you were an early investor in Stripe or Revolut, then whether you're investing out of a $50 million fund, a $500 million fund, or a $2 billion fund, in a way, it doesn't really matter. You're still going to generate really strong performance. So for us, it's much more about looking at the individual managers, understanding what their strategy is, understanding, what the likely exit size is going to be from the companies that they back, and then saying, is their fund size appropriate for that? Because it's really important that, the fund size is relative to the likely exit size that their companies are going to create and how much they own of those companies. Because, we want to see the best funds ultimately will generate fund returning outcomes from a single investment. So focusing on that relationship, I think, is much more important than focusing on whether the absolute size of a fund is small, medium, or large.
Why do you think we are talking about this? Like, why is this a thing? No, because many LPs do care about the size. So why do we have to challenge this? So why are we at this point?
I think what we've seen over the last few years is a number of reports come out that looked at the performance of small funds, looked at the performance of emerging managers, looked at the performance of different geographies, and they were based on the publicly available data sets that were out there. So predominantly for small and emerging managers, it was PitchBook. For Europe versus the US, it's Cambridge Associates. And the challenge with those data sets is that they only represent a really small sample of the overall market. So, for example, when you look at the sub-$100 million funds that are on PitchBook that have returns data, it represents less than 5% of the total number of sub-$100 million funds that have been raised over that period. And so trying to draw any specific conclusions from data that is just simply not representative of what the market really looks like, I think is incredibly dangerous. And so one of the things we try and do is just to throw some light onto that so that people, really do understand what the primary data is or isn't telling you about the performance of VC. And I think, building a strategy based on publicly available data sets, I think is a really dangerous thing to do because they just don't give you a strong enough and reliable enough signal.
Wonderful. And when it comes to fund size and the power law in VC, which is like what matters in venture capital in the end, is there any correlation between them?
Yeah, so one of the things we found looking at our data of investing in VC for nearly 40 years is that about 92% of early stage funds that were able to deliver us a 3x net multiple had at least one company that returned the entire fund. So I think, one of the lessons we've learned over time is that, having those fund returning outcomes is incredibly important. And it's going to be very difficult for a fund to deliver that 3x net multiple or better unless they're able to find a single company that returns the entire fund. So really that then comes down to making sure the relationship between fund size, ownership percentage, and exit value are aligned. So if you're raising a $1 billion fund, you really need to be able to own 10% of a $10 billion company at exit. And so the question for us as LPs is, if a manager is coming to us with $1 billion fund, we will ask a very simple question, which is how often have they returned $1 billion from a single investment? If the answer to that is multiple times, then it gives us much greater confidence in their ability to do it going forward. If the answer is never, then the challenge is we're backing them to get lucky. And we found that hoping you get lucky isn't really a viable investment strategy in venture.
I love that approach because it brings us to the next question, which is emerging managers, right? You don't invest into emerging managers, but what can we do with emerging managers? How can we make them grow and keep maturing? somehow?
Yeah, I think it's a really difficult question around emerging managers because, as you say, we will only invest in managers, where we see a consistent ability to back these top 1% companies. Historically, that meant really intercepting firms at Fund 3 because Fund 3, the Fund 1 companies had sort of 5 or 6 years to mature. Today we're seeing Fund 3s being raised maybe 4 years after Fund 1. So, today we're probably looking at it Fund 4 or Fund 5 before we think we're getting, really meaningful signal coming from prior investments. And so, we don't invest in emerging managers. And I appreciate that that's not helping to build the ecosystem. I think the one area where I think public money should be involved in the ecosystem is backing a Fund 1 or a Fund 2. Where I think where I have a real problem with public money coming in is when they're then backing funds that are on Fund 5, Fund 6, Fund 7. By that stage, those managers should either be able to raise money from the market generally without relying on public sources of capital, or they should go out of business. And so I do think there's a role for things like the British Business Bank and the EIF, but it should be restricted to backing Fund 1, Fund 2, marginally Fund 3, and then after that, firms should be on their own.
I think what you just said is like very, very insightful, right? Because that's like someone has to take care of the emerging managers, and then the market should take care of the ones that are maturing, right? And when it comes to specialization, what's VenCap's approach as a fund of fund, and also when you are looking for GPs?
So I think as LPs, it's really important for us to understand, what we're good at and what we're not good at. What I think we're good at is identifying those managers that are consistently able to back the top 1% companies and then going out, building relationships with them and ultimately, hopefully, investing in their funds. What we're not good at is trying to identify, where the companies, the very best companies in a decade's time are going to emerge from, whether that's the sector or the geography. So as a result, we don't invest in sector-specific funds, and we tend to be pretty agnostic about geographies as well. We'd much rather back the best managers and let them figure out where the best founders are coming from, both in terms of sectors and geographies. And that's actually played out pretty successfully for us. Even when you look at, the leading AI companies today and who are the early stage investors there, it was Khosla that was the first venture firm to invest in OpenAI, and Anthropic, Spark was one of the first investors there. With Mistral, Lightspeed led the seed round there. And then just a few weeks ago, there was a company called Cursor, which is an AI company that was reportedly the fastest company to go from $1 million to $100 million in revenue. And the A-round investors there were Andreessen Horowitz and Thrive. So the very best generalist managers can consistently find the best founders, almost regardless of the vertical. And we'd much rather take that bet than on our ability to predict sectors.
Wonderful. And finally, what's going to happen? Because you are an LP that invests into venture capital, and venture capital has been having not the best years in the last 2 to 3 years, right? So, but this year is supposed to be better, and things are supposed to be better from now on. What do you think about that?
I think it's really interesting that people are, tend to focus on the short term in venture when the life of an average venture fund is like 15 years. And over those 15 years, you're going to have, recessions, you're going to have booms, you're going to see multiple parts of the economic cycle. And so that has to factor into how you build your portfolio and how you structure your program. It's really important that any venture program is able to capture the upside in the good years, but is also really resilient when that correction happens. And it will happen as part of your, within your program. Your strategy has to make sure that you're not giving away all of those gains when the market corrects. And actually for us, we don't try and be tactical. We don't try and focus on the short term or try and market time. We believe the best way to generate long-term, consistent, top quartile performance is by backing the best managers and doing that consistently over the long term, not trying to predict the best time, the bottom of a market or the top of a market. We want to keep a relatively consistent investment pace and make sure we have access to the very best companies when they ultimately look to go public. If anything, it's interesting. I felt as an LP, quite bored during the period from sort of 2018 to 2021 because everything everything looked great. Every manager looked great. Every company was doing amazingly well. And, we've been doing this for long enough that we know that's not how the venture industry operates. We know there's a power law in there. We know there's a small number of companies that ultimately generate the value. And we know that the majority of VC investments won't return cost. And so I think what we're seeing now is a return back to that power law dynamic. So I think over the next few years, you're going to see much greater differentiation in terms of manager performance. I think you're going to see the very best companies really outperform. And unfortunately, I think you're going to see a lot of funds go out of business. And there are still a lot of companies that were able to raise capital at the top of the market who haven't been able to raise capital subsequently, but haven't yet been marked down or haven't been written off. And I think that's likely to happen over the next couple of years. So I think there's going to be a real bifurcation within the industry of those managers and companies that are going to be successful and the rest of the market. As an LP, if you're fortunate enough to have backed one of the managers that's going to be successful because they've backed one of those top 1% companies, then I think you're going to do well. And I think that's the case whatever the prevailing market sentiment is in the venture industry.